welcome to another edition of Trust Issues by Kepler Trust Intelligence. In this podcast, we speak to leading investment trust managers about the philosophy behind their strategies and the themes shaping their portfolios. In today's episode, we're joined by Doug Ledingham, manager of Pacific Assets Trust, to explore where he's finding opportunity across Asia's diverse markets. So Doug, many thanks for joining us today.
Thank you very much for having me.
So if we could start off with the big picture, could you walk us through your investment philosophy and how you assess quality when you're identifying a potential investment for the portfolio?
Sure. So our objective is to deliver very attractive rates of long-term capital growth to our shareholders. I mean, ultimately, we would love to be known as the best long-term investors in Asia. But there's many ways up the mountain. For us, it's a focus on long-term capital growth with an eye on capital preservation. Very simply understanding that if we want to compound our shareholders' capital, we can't lose it along the way. Our philosophy at Stewart Investors has been consistent over the last 35 years, but really the fundamental part of how we approach stewarding our clients' capital is our view of risk, and really seeing risk as the risk of losing clients' capital rather than deviation from a benchmark. And that really, frees us up to take a truly active approach to allocating our clients' capital. And I think you see this in the Pacific Assets Trust and in how it looks and behaves very differently to the index. We don't believe that we have any ability to create any value for our shareholders by taking a short-term perspective and trying to guess, our peers and the market on what's going to happen next quarter or next year. Instead, we take a 10-year time horizon at point of investment. And I think that view of risk and that time horizon probably takes us to a very different set of questions and about how we assess quality and how we think about investing our clients' capital. And I think what's something that differentiates us to others that think about quality is our focus on people. I think if you are taking a 10-year time horizon, who you're handing your money to, becomes a very pivotal question. And we spend a lot of our time understanding the alignment of the people that we're investing behind, their competence, their track record, how they think about risk. That plays a pivotal role for us. And you really see that, I think, in the outcomes of the trust. And 90% of the trust capital is invested in companies that have a family, a foundation, or a founder behind them. And I think in a world that's increasingly short term, I think it's a bit of a superpower to be able to run counter to that onslaught of short-termism and with that ability to think and act differently. And whether it's in investment management or, creating any business, you can only really create something of enduring value if you do have that ability to think differently. So certainly that people aspect, I think, is an important differentiating factor of how we think about quality. The second one is, we care a lot about sustainability positioning. And for us, it's a very simple outcome of taking a 10-year time horizon. If we want to own companies that have the highest quality cash flows over the next 10 years, and we believe that it's the growth of those cash flows over the long term that drives share prices, we want to understand all the ways that we can lose clients' money, and having companies whose cash flows are at risk of either impending government regulation or a shift in consumer mindsets are, to us, risks to cash flows and therefore risks to our clients' capital. So certainly quality of people and sustainability positioning are key inputs, and I think have been key drivers of the returns that you've seen the Pacific Assets generate over the last 15 years.
Thanks for the really interesting perspective on how you look at your investment philosophy. Bringing the next area I wanted to talk about, and that's current allocations. Mm-hmm. So you've recently increased your weighting to China. Could you talk us through what's behind that shift? And also, do you approach investing in China differently, for example, compared to other markets in the region?
Thank you. So the point on your question on investing differently in China. So coming back to how we think about risk, that risk of losing clients' capital. So we always want all our conversations, debates to be carried out in absolute terms. So we don't want any change in framing of quality or change in framing of valuation when looking at a particular country. If we can't find an acceptable opportunity in a particular sector or country, we're very comfortable having nothing invested in there. So always the same philosophy applied to everything that we look at. If you'll allow me, I think I'll provide perhaps some context to the evolution of the China holding over time. So if you look back to 2010, 2011, where we first took over management of the Pacific Assets Trust. So Hong Kong and China, I think, contributed over 20% of the allocation, whereas India was roughly 10%. Over the subsequent 10 years, there was a material evolution of that exposure, with China going down to sub 5% and India becoming a very material holding. And that hopefully reflects what we want the portfolio to do, and it always reflects the best opportunities that we see to protect and grow clients' capital over the long term. And as the opportunities evolve, we will hopefully evolve the portfolio. And coming back to that point on being truly active, we have the ability to allocate and make the portfolio look very differently to the benchmark as and when opportunities present themselves. So in 2015, we had the ability to invest in mainland companies with the opening of the Hong Kong Stock Connect. And for those listening who have known Stewart Investors for a long time, they'll appreciate that we tend not to move very quickly. So for us, in terms of China, we spent our time traveling there, building up our own understanding of the investable universe. Financial history is an important input to how we assess financial quality and the quality of the people that we're investing behind. And for us, many of the very interesting franchises that had the characteristics that we look for in regard to pricing power and competitive positioning based on intellectual property and branding, they hadn't been listed for very long. So for us, there wasn't that ability to lean into financial track record that helps us build trust. So yeah, we took our time. I think maybe one example of a company that we own in the portfolio today, Shenzhen Innovents, which is one of the leading robotic and automation companies in China. I think we met them perhaps 12 or 13 times before we invested. So yeah, certainly a long period of getting to know these companies. And we were provided that time by the fact that the valuations of these companies, the types of companies that we get excited about, were not very attractive. They weren't cheap. And I think that runs counter to much of what is said about China when you look specifically or explicitly at the index. China's always been cheap. But I think if you remove the state-owned banks, the large insurance companies, the resource companies, and you're left with the companies with the characteristics that we really get excited about, valuations were not acceptable for us. So we're very happy in those situations to sit on the sidelines, keep our hands behind our backs and take our time to get to know these companies. Then you jump forward to 2020, 2021, and you really saw material sell-off in China. And for bottom-up stock pickers, that tends to be quite an exciting opportunity for us when there's indiscriminate selling, no matter what the company does, who owns it, the balance sheet, the valuation. So, we got excited about the opportunity set there. Valuations, for every company, came off and allowed us to really reassess the investment opportunity. And then at the same time, you had Xi Jinping and the CCP. I think obviously there was a material regulatory crackdown at the same time as you had economic weakness, which was the precursor to that sell-off. But I think more recently you've seen more positive signs in regards to how the party thinks about private enterprise in the context of economic growth and the context of the party's desire to wean themselves off foreign technology. So yeah, valuations came off and the opportunity set evolved, and I'd hope that that's where you would see us move, and that our clients and shareholders are not surprised that we have evolved the portfolio. I think given the weight of the portfolio in India for the last 10 years, I think we were concerned that perhaps we were seen as an India plus type strategy, but hopefully the portfolio is a reflection of where we see those opportunities. And more recently, we've seen those opportunities present them in China.
And talking of country-specific opportunities, we've also seen some interesting moves into the Philippines. Could you perhaps share the investment case behind one of your holdings there?
Yeah, certainly. So yeah, as you said, Philippines is between 7 and 8% of the portfolio at the moment, and we have been adding to that over the last 12 months or so. That really is a function of where we're seeing, in our view, attractive opportunities for the next 10 years. It feels like the Philippines is a bit like the market that the foreign investors, forgotten about. We were in Manila a couple of months ago, and we had a broker take us round. And I think the broker, when they first saw us, it was, they were casting their eye on some being from another planet. I think they hadn't seen a foreign investor for a very long time, which, is exciting to us because it tends not to be something that happens at the top of a market.
Absolutely.
So yeah, a company that we one of the larger Filipino holdings at the moment is a company called Ayala Corporation, which is one of the larger holding companies, kind of conglomerates in the Philippines. It's now in its 8th generation of family ownership and really has a wonderful track record of treating all stakeholders, in our view, very fairly, whether that be minority shareholders or employees or suppliers. It's a company with a very good reputation. What's really attracted us more recently is the introduction of the first professional CEO since 1830, which is a pretty strong signal of change. Now, for us, people change it gets us interested because it tends to mean that there has been a change of mindset, and for us, we believe that people matter, and certainly change in people can lead to change in behaviours, which lead to a change in outcomes. And I think by taking a view of the people before it appears in the financial statements, we do have an ability to take in a divergent view of others who maybe wait for financial numbers to drive decision making. So you're coming back to Ayala, the new professional CEO. The second point that really got us excited is that he has chosen or has been able to shrink the portfolio. I think it's very easy when you're a new CEO to come in and say, we're going to go out and buy this and we're going to invest here. It's far harder to say, actually, things, I think from my first port of call is to trim and shrink. And even harder if you are selling assets that the family owners have chosen to invest in. So the fact that the Ayala family is willing to accept the changes being brought about by the new CEO is, again, a very strong signal of change for us. And Ayala Corp has a very diversified set of cash flows that come from property, from telecoms, from banking. And banking in the Philippines is very interesting, given that there's a very large young population, 50% of which don't yet have access to a bank account. So a very long runway of growth, and that growth largely insulated from global geopolitics. And finally, just valuations in the Philippines are at or lower than those levels seen in the GFC or actually the Asian financial crisis. So yeah, for us, coming back to that point on what should a position size in specific assets reflect, and it's a conviction for us in that combination of preservation and growth, and valuations of less than 10 times with the people change going on, and resilient set of cash flows. It's a pretty attractive opportunity for the trust. Now, I think at these valuations, we're not trying to be too smart in time when the foreign investors are going to come in and start buying these companies again. For us, the earnings growth and the earnings potential provides enough of an opportunity for attractive growth, and there's a bit of a cherry on the top if we were to see a material re-rating. But yeah, the Philippines is an interesting place, and like I said, I think it was a very fascinating and enjoyable trip to Manila that we had a couple of months ago.
Fantastic. Thanks for running us through that. You touched earlier, I think, on capital preservation, and the trust has delivered positive absolute returns in 9 of the last 10 years, which showcases its impressive consistency. How do you think about capital protection, managing downside risk for investors?
I don't want to sound too much like a really pessimistic Scotsman here, but obviously risk is vitally important to us in terms of how we manage our role as stewards of clients' capital.
Absolutely.
And we, as a team, are looking to deliver that, like I mentioned, that really attractive long-term returns to our clients, long-term compounding. And we're really very quickly trying to avoid all the ways that we can lose clients' capital very quickly. So I think if you were to see the kind of defining characteristics of a typical Stewart Investors or Pacific Assets type company, it's coming back to that point on owners. You've got somebody who has their own capital invested alongside us, who, whether that's both financial and reputational. We've got generations of brand name of family reputation, which is very important, and is a vital component to how risk is managed at the company level. Leverage works wonderfully well in the good times, but will take you out in the bad times. And leverage is something that you tend to find that companies that have been around for a long time run away from. So coming back to our point, when we are looking for people that we trust with the trust capital, companies that have survived a long time, that cycle scars from previous inflation and interest rate environments, scars from previous coups and political transitions, all these lessons contribute to building a business that is built for survival and resilience. And the types of companies that we're owning and we're handing clients capital to, they know that leverage puts their long-term survival at risk. So our companies tend to have a lot of cash, which runs counter to what investment banks and Wall Street will tell you is an efficient balance sheet. But again, coming back to what's worked, the companies that we own, the people at the top know that at the bottom of a cycle, the inevitable down cycle that you can't time, you want control and independence of thoughts. You don't want to have to be selling things to satisfy creditors. You want to be able to retain employees. You want to be able to invest counter-cyclically. You want to treat your suppliers fairly. And it's really fascinating when you look back at behaviors of these types of companies during downturns. And that's really where they set the foundation for wonderful long-term performance. But it's something that in the investment industry is not given enough credence and focus. And I think partly because it's too qualitative and airy-fairy. You can't really put those kind of behaviours to two decimal places, but it's something that we spend a lot of time thinking about. So yeah, running away from leverage and hopefully trying to manage the wonderful combination I think that's required of long-term conviction and humility. So humility in this regard is knowing that we can't forecast the next cycle. I think if you look back over the last 15 years that we've managed the trust, we wouldn't have predicted any macro cycle or any major headlines, but the portfolio hopefully has tended to behave in a relatively consistent manner. And that comes back to looking to build a portfolio that's robust and resilient to most macroeconomic environments. And that comes back to who we're investing alongside and having a portfolio that's diversified from not only a listing perspective, but more importantly from a cash flow perspective. Not allowing the portfolio to be too exposed to one single point of failure. And to look at our Indian weighting, for example, it's a very material position that we have in India, but underlying that we have, in our view, a very robust diversification of cash flows in the real sense, whether it be cash flows from selling tractors, from selling mortgages to selling air compressors. There's hopefully a diversification there that means that that inevitable cycle when it does come, that our clients' capital is not a material risk of that single point of failure. So yeah, it's long-term positive, but always trying to worry about what can go wrong is probably best summed up about how we approach the fund.
Putting that in its broader context, how would you say Pacific Assets is differentiated from its peers in the sector?
I think if you were to look at what the portfolio looks like, so if you were to look at the top 10, the country allocation, how the portfolio behaves in varying markets, I think Pacific Assets looks and behaves differently to peers. And now I believe that's a function of those three aspects that we touched on at the beginning. It's what's important to us. What's important to us is how we think about risk and being truly active in our approach. And we have a portfolio that looks very different to the index. And then when you look at how those companies behave over time, they are behaving in a way that is reflective of who is owning those businesses and the decisions that they make over time and the positioning of those companies. So when there is a down cycle, when there's uncertainty going on, that our companies, because of what they're offering to customers, the demand tends not to disappear at the bottom of the cycle. Their survival tends not to be in question because they've got lots of cash on the balance sheet, and our focus on sustainability positioning again leads us to see risk and return in a very different light, I think, to those that perhaps have a more quantitative approach to quality. So I think, very simply, I hope that what we say in terms of how we approach allocating the trust precious capital is reflected in the outcomes over the last 15 years. Really, that's what we're looking for. And we're looking for clients to trust that we will maintain an emphasis on the long term. And all philosophies, in my view, have a trade-off if they're adhered to strictly. And we are, we have a team, a culture, a philosophy really set out to try and be the best long-term allocators to capital in Asia. And we would seek to be measured over 10, 7, 5-year timeframes. The cost of that is giving up trying to outperform every 12-month period, which is taxing. It's challenging, but that's what the cost of what we're trying to achieve is. And when we're talking to clients, I hope when we can sit in front of them, look them in the eye and say, nothing's changed. We have underperformed for these reasons, but hopefully we can prove to you that we continue to walk the talk in all these ways. So yeah, hopefully I've answered your question there.
You most certainly have. Pivoting onto a very hot investing topic at the moment, I'm sure you know what I'm about to ask. It seems almost impossible to get through a podcast without mentioning the T word, or should I say T words? What do you see as the potential opportunities, but also the risks of the Trump administration, including around tariffs?
Yeah, I think obviously it's something that we've spoken about and thought about a lot as a team, and constantly assessing how that impacts our companies over the long term. I think it's too easy to read headlines and too easy to see share price volatility and let that impact how we think about risk and return. So during these environments, we've really tried to take a step back, and it's really in these environments where getting on the road and talking to companies, understanding how they see risk is vitally important, because when we talk to a company where the family or the founder has all their wealth invested in one single company, they think about risk diversification in a very real manner. And I think that's been an important way that we've sought to educate ourselves and not get drawn into reacting to news and reacting to headlines. So coming back to the companies and the uncertainty and volatility that these headlines has created, I mean, looking back again on history, these are environments are where companies who have a long-term time horizon and focused on solving clients' problems, I think, have a real advantage. And, there's a couple in the portfolio that I think probably provide really pertinent examples of that. And one is a Hong Kong-based company that we own that manufactures power tools. Power tools both used in the DIY user case, but also for professional contractors. Now, our company, thanks to its family ownership, has a very strong balance sheet with very strong cash flows. Now, their competitors who are professionally owned, don't have a long-term owner, they have a heavily indebted balance sheet and have promised shareholders consistent dividends and buybacks. In a world where all power tool companies have very similar supply chains, they're largely in a similar boat in terms of how they have to pass on tariffs. Now, our company has that ability to think and act differently, which I think sets the scene nicely for future returns, and that their competitors in the US will have to raise prices to be able to pay their debts and pay those dividends. Now, our company has the decision to raise prices in line with its peers. It's got a brand that allows it to do that should it desire, or it could choose to raise prices less than its peers and therefore grow market share at a time of stress and volatility, and really set that foundation for creating long-term loyal customers over the next 10, 20 years. Now, I think that's a wonderful example of that ability to think and act differently in times of stress. And I think another example probably quickly to touch on is, if tariffs are going to increase prices and uncertainty, we need companies where the value proposition to the customer is not where price is number one priority. We're looking for companies where safety or productivity or efficiency and all the kind of qualitative elements to decision are more important. And that's where we get really excited about some of the Indian industrial companies that we own in the portfolio, where you've got really long-term minded owners and families that are truly aspirational in what they're trying to deliver over the next 10, 20 years. So they're not satisfied simply by taking a leading market share in the large domestic economy in India, but they're looking to go and take on US and European peers in their backyards. And European industrial companies, they're big and bureaucratic and a bit slow moving. And I think if you were aspirational, Indian owner, and you were, had these companies pinned up on the wall, I think you'd be pretty excited about what you could do. But again, coming back to when we talk to these companies, they know that if they're going to be world-class over the next 10, 20 years, they have to have a brand that individuals in the US or Europe trust, and that they have to compete on quality of service and quality of offering, not just simply leaning into price arbitrage. So, that comes back to, for us, what we're looking for in companies, and what are we looking for in the people that we're handing the trust capital. And there is, again, coming back to that point on superpowers, that ability to think longer term and own a business is vital, and it really comes to the fore when there's a lot of uncertainty and volatility around you.
And on that very positive note, many thanks to Doug for joining us today.
Thank you very much for having me.
And I'd encourage you to visit the Stewart Investors website to find out more information about the trust. And if you'd like to read our latest research note, please head over to the Kepler Trust Intelligence website. Thank you very much for listening, and we hope you join us again soon for another edition of Trust Issues. Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorised and regulated by the Financial Conduct Authority.